Welcome to this week's episode of Jonathan on Money. This is episode number 171. Well, the summer is basically half over, which is super depressing for me. I'm not really sure why. It's not like I have to go back to school, but something about the warmer weather and more sun certainly sparks joy in my life, where the dark, cold, and idea of school still make me sad. While the first half of summer was very hectic for me with work and family matters, which is all good stuff. I'm hoping the second half of the summer I can spend more time vacationing at the beach, where I've only been one time this year, and taking it a bit easier. Will there be themes? And I hope those are going to be the themes of my August. I tend to come back from a good vacation or break feeling rejuvenated with tons of new thoughts, ideas, and strategies for my clients and for content to put out. So taking it easy is certainly a good practical investment as well. In other news, don't forget to get my book, D's for Diversification, the ABCs of Personal Finance, which is now available on Amazon or at jonathanonmoney.com. And buying this book is still a wonderful way to support this podcast. And finally, before jumping into this week's episode, I'd like to share that my upcoming live fall webinar series will be released in the coming weeks. If you or a friend would like to be notified of my upcoming series, you can either go to parkbridgewealth.com/webinars and register to be on my webinar distribution list, or email me directly with the word webinar in the subject line to be added to the list. Okay, now for today's agenda. My talking points this week will discuss when everyone depends on you, financial survival for the sandwich generation. Our quote this week is from Morgan Housel on the downside of having money. I'll spend the last half of the episode answering listener questions, including when municipal bonds are taxable. And finally, we're going to end with an actionable idea to implement your investing life, where we'll discuss mid-year financial resolutions. And with that, let's jump into this week's talking points. So I received a version of this question. I receive it every so often, and it goes as follows. This is the one that was submitted to me. Every Yontif, I host my parents, in-laws, and children with their spouses. That's a lot of people. Hope the bedroom to bathroom ratio or people to bathroom ratio is good. It's truly beautiful, but it's also financially overwhelming. In addition to the cost of the holidays, which is just a one-time annual expense, my spouse and I help support our parents throughout the year, contribute to our newly married kids' expenses, and cover college costs for our son. As a result, we save very little for ourselves and feel stretched incredibly thin. Do you have any guidance on how to manage this financial strain with so many people relying on us and still needing to protect our own financial well-being? So while hosting multiple generations is a privilege, it can also create significant financial strain. This tension is particularly acute for those in what financial planners call the sandwich generation. This isn't a demographic defined by age or by circumstance. It's the cohort of people who are simultaneously supporting aging parents and launching their own children into adulthood. They are the ones everyone turns to financially. I'm going to offer some practical suggestions on how folks in this demographic can navigate these challenges and plan for their own financial future. First, let's understand the sandwich generation. Within the Jewish community, the sandwich generation dynamic can be even more pronounced than in other cultures. Values such as kibbud av v'em and the importance of supporting children as they build their lives are deeply ingrained. These are not obligations people take lightly. However, the financial reality of trying to do everything for everyone can create a precarious situation. If you give too much of your financial resources to others, you risk undermining your own future. Ironically, this can lead to becoming financially dependent on your children down the line, perpetuating the very cycle you were trying to prevent. The challenge is not whether to help, but how to help in a sustainable way. You got to start with a clear financial picture. That's the first step. The first step is understanding the full financial landscape for both yourself and your parents. For aging parents, this means taking a detailed look at their income sources, including Social Security, pensions, or retirement savings. Next, consider whether their income is paid off, their home is paid off, and what their ongoing expenses are. Identifying whether there's a shortfall and how large it is can help you plan more effectively. Many families avoid these conversations because they are uncomfortable. However, delaying them only makes the situation more difficult later, especially if a health issue or financial emergency arises. Clarity allows for proactive decision making rather than reactive scrambling. Next, managing parental expenses. If your parents require financial assistance, it is necessary to examine their expenses closely. This may involve difficult but practical decisions such as downsizing a home, reducing the number of vehicles, or eliminating services they no longer use. If you are helping finance your parents' lifestyle, it's appropriate to have a say in shaping that lifestyle in a way that is sustainable. Another consideration is planning for long-term care. One of the most significant financial risks for the sandwich generation is long-term care. Traditional long-term care insurance is often prohibitively expensive for older individuals or unavailable due to health issues. Alternative solutions such as hybrid life insurance or annuity-based products may offer partial protection, but they are not always feasible. In those situations, if those options are not available, families should begin exploring Medicaid planning well in advance. Waiting until care is urgently needed can result in unnecessary stress, higher out-of-pocket costs, and fewer options. Long-term care planning is not just about finances, it's about preventing dignity and ensuring that parents receive appropriate care. Next is the importance of estate planning. Estate planning is another critical and often overlooked component. Without proper legal documents such as powers of attorney, healthcare directives, wills, and trusts, adult children might find themselves unable to assist their parents when it matters most. Financial institutions will not allow access to accounts without proper authorization, regardless of family relationships. These documents should be put in place early, reviewed periodically, and updated as needed. Waiting too long can be risky, particularly if a parent develops cognitive impairment and is no longer able to execute legal documents. There are housing and living arrangements. Families also need to think carefully about where aging parents will live. Aging in place may require costly home modifications such as ramps, stair lifts, or accessible bathrooms. These decisions are best made proactively, not in the middle of a crisis. Now let's discuss helping children become independent. While supporting parents is often unavoidable due to their inability to re-enter the workforce and earn an income, the same is not always true for adult children. At a certain point, children need to become financially independent. Continuing to subsidize their lifestyle indefinitely is not only financially draining, but can also be counterproductive from an educational and developmental standpoint. If your children can work, they should be encouraged to contribute to their own expenses. This does not mean cutting them off abruptly. A more effective approach is to establish a clear, gradual transition plan over 1 to 3 years. During that time, financial support can be reduced in stages, giving them time to adjust and build independence. This is not only financially responsible, it is also good chinuch. Teaching children to live within their means is one of the most valuable lessons you can provide. Another important strategy, which may sound simple, is to build and maintain an emergency fund. When you're supporting multiple generations, unexpected expenses are almost inevitable. Without an emergency fund, those expenses may lead to borrowing, which can quickly compound financial stress. This is why it's imperative to always maintain a cash cushion, which will provide a critical safety net when an unexpected expense arises. You should also pay yourself first. One of the most important and most difficult principles for the sandwich generation is paying yourself first. Before allocating money to discretionary expenses and family, it is essential to prioritize your own long-term financial security, particularly retirement savings. Failing to save for your own future increases the likelihood that you will eventually need financial support from your children. By taking care of yourself now, you are ultimately protecting your family from that burden. Whenever possible, make full use of tax-advantaged retirement accounts and employer matching contributions. These benefits can significantly enhance long-term savings. You should also know what to cut. When finances are tight, not all goals can be prioritized equally. Some expenses, while desirable, may need to be reduced or eliminated. For example, paying for college should take a back seat if you are not adequately saving for retirement. There are many ways to finance education, but no equivalent for funding retirement. Similarly, discretionary expenses such as frequent dining out, luxury vehicles, or extensive vacations may need to be scaled back. Making these adjustments can free up cash flow and provide some much needed breathing room. There's also investing wisely and managing debt thoughtfully. Saving money is only part of the equation. Those savings are invested, how savings are invested, I should say, matters a lot. Being overly conservative, such as keeping long-term retirement funds in cash or short-term bonds, can significantly limit growth over time. A thoughtful investment strategy that balances risk and return is essential. Additionally, debt management is equally important. Instead of focusing solely on monthly payments, consider the total cost of borrowing. Long-term loans, such as extended car financing, often result in significantly higher interest costs. When purchasing a home, it is wise to focus on what you truly need rather than maximum you can afford. Rising costs for insurance, maintenance, and taxes can add up quickly. As always, there's no one size fits all solution. Every family is different. Financial situations, family dynamics, and personal values all play a role in shaping the right approach. However, the underlying principle remains the same. Supporting others should not come at the expense of your own long-term stability. Bring it back to the question. Sitting at a table surrounded by multiple generations over Yontif is a powerful reminder of what truly matters. With thoughtful planning, honest conversation, and disciplined financial decisions, it is possible to honor those responsibilities while also protecting your own future. That balance is not easy to achieve, but it is essential. Okay, those are the talking points this week. And as a reminder, you could be notified of all my recent articles, webinars, and all the work I put out by subscribing to my free monthly newsletter at parkbridgewealth.com/newsletter. This week's quote is from Morgan Housel. For those who don't know, Morgan Housel, whom I've referenced many times before, is a best-selling author and one of the most influential contemporary writers on behavioral finance. He's a partner at Collaborative Fund, a venture capital firm focused on innovative companies, and previously wrote award-winning columns for the Wall Street Journal and the Motley Fool. His work blends psychology, history, and storytelling to make complex financial ideas accessible to a broad audience. And Housel once wrote, "Money is a financial asset, but psychologically liability." Money is one of the, so my thoughts on this is that money is one of life's greatest paradoxes. Financially, it's an asset that provides security, opportunity, and freedom. Psychologically, however, it can become a liability. The more wealth people accumulate, the more they often worry about protecting it, investing it correctly, paying taxes, providing for children, or preserving it for future generations. It also makes people self-conscious. And I remember when I studied in yeshiva, there was a very wealthy classmate, several actually, but I'm thinking about one in particular who was concerned that other students would try to use him for his family's money, and his concerns were not unfounded. He kept to himself most of the year and didn't really branch out of his immediate friend circle, partially for this reason. Money had, in my opinion, had an adverse psychological impact him at least through that year. Rather than eliminating anxiety, money can simply change its focus from wondering how to make ends meet to wondering how to avoid losing what has already been built and worrying about social implications like the one I mentioned. The key is to view money as a tool, not a source of identity or security. A thoughtful financial plan, disciplined investing, and clear understanding of what is enough means for your family can help transform money from a psychological burden back into what it was always meant to be, a means to living a more fulfilling and meaningful life. Okay, now let's jump into this week's financial questions. And if you do have a question, feel free to submit it to me, and it may be answered in a future episode. First question, what's a SERP plan? Exciting question. So a SERP, spelled SERP, is an employer-sponsored plan designed to attract, retain, and reward high-ranking executives whose contributions to qualified plans, such as a 401k, are limited by IRS regulations. As a non-qualified plan, a SERP does not require IRS approval and is exempt from most ERISA rules, allowing for highly customized designs. SERPs are typically funded by the employer, usually through corporate-owned life insurance or general corporate assets. Benefits grow tax deferred, and executives are not taxed until they receive the payouts, which is usually in retirement when they may be in a lower tax bracket. The employee receives a tax deduction at that time. These plans can be tailored with individualized vesting schedules, often referred to as golden handcuffs, and flexible payout options such as lump sums or annuities. However, because the assets remain part of the company's general funds, they're subject to creditor claims if the employer faces bankruptcy or financial distress. So there's risk there. Is it true that if I'm on a boat in international waters on April 15th, I won't owe any taxes? I saw a video on TikTok and have my suspicions. I am flabbergasted by this question. I shouldn't feel this way because I know that most people get their financial education from social media influencers, their broke deadbeat brother-in-law, or the big macher in shul who just finished a 5-year stint in Otisville. Allow me to take a breath and compose myself. Serenity now. Serenity now. Serenity now. I'm back. No, not being in no being in international waters on April 15th does not give you a pass on paying your taxes. What are the responsibilities of a trustee? I feel this guy we work with gets paid a ton of money, but doesn't actually do anything. I know the feeling. I've had many clients vent to me about their frustrations regarding trustees of a trust they are the beneficiary of who seem to get paid a boatload of money but don't actually do anything. By way of background, a trustee's primary responsibility is to manage trust assets for the benefit of the beneficiaries, acting as a fiduciary by following the trust documents, instructions, investing prudently, paying bills, filing taxes, keeping accurate records, and distributing assets fairly and impartially. Trustees must always act in good faith, avoid conflict of interest, and place the beneficiary interest above their own. Key duties include identifying and taking legal title to all assets, settling outstanding bills and debt, making prudent investment decisions, providing financial reports to beneficiaries, and seeking professional advice such as from attorneys or accountants when necessary. In essence, the trustee steps into the grantor's shoes to ensure the trust operates smoothly and fulfills its intended purpose, carrying significant legal responsibility for their actions. Trustees can charge 1 to 2% of assets, and this may be on top of your financial advisory fee that you're paying. Not a bad gig, especially when you're not doing much. When drafting a trust, it may be worth considering a trust protector so a third party can fire the trustee if they are not doing their job adequately. What should my son do with his bar mitzvah money? And this is one of those things that I've covered before, but worth repeating. Depends on some factors. For example, do you plan to cover your son's expenses until he graduates college? If so, you should encourage him to invest it so it grows and he has funds to start his life. This may also be a good way to familiarize himself with investing. If you think your child should pay for all or some of his toys, activities, etc., then perhaps you put it in a checking account, explain to him that it's his money to use as he pleases, but you are not replenishing it so he can decide to save it, invest it, or spend it. It's up to him. This will teach him responsibility. You can have your son do some investing and some spending, or he can blow all the funds, learn that money doesn't grow on trees, which will instill the lifelong lesson of being financially prudent. Most importantly, I think that receiving money at a young age can be a good opportunity to get the wheels turning on your son's financial education. Even though a 13-year-old boy will have more important priorities at this point, like playing Yeshiva League floor hockey, studying for the BJEs, chasing tail, and saying 6-7, planting the seeds of financial literacy will pay off dividends in the future. What should the perfect portfolio look like? There is no such thing as the perfect portfolio. Frankly, there's no such thing as perfection in the world. Only Hashem is perfect. The people that are in pursuit of perfection will just end up disappointed and stuck. That being said, the perfect portfolio is the one that you could stick with over the long run. One of the biggest challenges with investing is the ongoing desire to want to pachka around with one's investments, which inevitably leads to big mistakes and low returns. This desire to pachka stems from a variety of factors, including nervousness about the market gyrations, outside influences like friends and family saying you should be doing something different, second guessing your strategy, etc. The truth is, it's better to stick the low returning investment over the long term and let compounding work its magic rather than tinker around with potentially higher returning investments regularly, which will just set you back financially. I think education and experience helps improve an investor's ability to stick with a sensible portfolio where they can take us on sufficient risk in order to outpace inflation. Nonetheless, it's still better to invest in lower returning investments over the long term if it improves the likelihood of you sticking with it. Playing the long game with all decision in life is the closest that any mortal can get to achieving perfection. Can you explain something to me? I have an old 401k And my CPA looked at it and said that it's invested properly because it's been up 20% annually over the past 3 years. My financial advisor seems to disagree and says that it is invested inappropriately for my age and I should change the allocation. Who's right, my CPA or financial advisor? For context, I'm 81 years old. Thanks. Your financial advisor's right. I don't even need to see the breakdown of investments to determine that. At age 81, if your money's invested so aggressively that it's achieving 20% annualized returns, that also means you're taking enough risks to be down 20 to 50% in any 18-month period. Most 81-year-olds should not position their investments to include that much risk. That level of risk may also translate into many years of stagnant growth or no growth. This type of risk is especially risky for retirees because it may lead to exhausting their funds well before they die. The risk is not commensurate with potential reward. No 80-year-old wants to end up on the streets and probably doesn't have parents they can live with, and imposing on their kids may not be an optimal situation. At your age, you should be playing it safe by worrying less about hitting home run investments and instead focusing more on your goals, which is not running out of money in retirement. Next question. I own Disney stock and a few other stocks from my bar mitzvah, which took place 25 years ago. They have grown a lot, and I want to use the money to buy a home in Israel. The issue for me is psychological. These stocks were given to me by my grandfather, and he's no longer with us. How do I get over this psychological hurdle? Or should I not sell them and find another way to finance this home? This conundrum comes up more often than many people think, and I can appreciate your dilemma. However, I think you need to tweak your perspective. Your granddad gave you these stocks for your financial future. Additionally, purchasing a home in Israel by using the proceeds from this bar mitzvah gift is the ultimate use for these funds. Imagine if your grandfather was here today and you told him of your intentions. I imagine he'd be ecstatic. Buying a home in Eretz Yisrael after all the oppression that your family and ancestors faced throughout history, what a dream come true. You should use these funds for this type of purchase. You should feel happy about this decision. Your Zaidi is certainly looking down from Shemayim, shepping tons of nachas, and giving you the thumbs up for approval. If I buy a municipal bond at a discount, is the entire yield to maturity considered tax-free? Good Shyla. No, just the coupon payment is tax-free. The entire yield to maturity on municipal bonds bought at a discount isn't automatically tax-free. The discount portion, or the gain from buying below par value, is often taxable, either as capital gains or ordinary income, depending on the size of the discount and the de minimis rule. While coupon payments on munis are typically tax-exempt, the appreciation at maturity from a market discount is a key exception, so only the coupon interest and any small discount under the de minimis threshold are tax-free. In terms of the de minimis rule, if this discount is small, i.e. de minimis, which is classified as less than 0.25% per year to maturity, the gain is taxed as a capital gain. For larger discounts, which are above the de minimis threshold, the gain is taxed as ordinary income. When you're pitched a muni bond, be mindful of this rule if you are a tax-sensitive investor. Okay, that's it for financial questions this week. And by the way, if you have a more involved personal finance situation, feel free to reach out directly to me or my team so we can help you. The best way to get a hold of me is via email at jonathan@parkbridgewealth.com. And finally, I'd like to end with a timely and actionable idea that listeners can implement to their own financial lives. And today's timely idea is to revisit your New Year's financial resolutions. Since we're in the middle of the year, in particular the slower summer months, it may be worth revisiting your New Year's financial resolutions to keep you on track. So, as I've mentioned at the beginning of this year, I don't have traditional financial resolutions, but rather a framework that I try to stick to. Here are a few things that I stated that I would prioritize with my money at the beginning of 2026, and what I suggest other people commit to as well. One, I said I would pay myself first. The first thing I do, and something everyone should try to do, is pay yourself first. This is the cornerstone of having a successful financial year. If money is automatically moved from your checking account into savings or investments, you probably won't miss it. The philosophy allows me to prioritize savings for various goals and spend guilt-free with whatever cash I have left over. I did this early in the year, so check for me. Two, always diversify. It is tempting to concentrate your investments or try to time the market, but the chances of success are low. Stay diversified across stocks and bonds, no matter how boring it is. And I did this too. So check for me. And by the way, it's starting to pay off, especially with the international markets, which have performed extremely well relative to the US markets as of late. Three, avoid alternative investments. Sometimes the best decisions come from knowing what to avoid. From my vantage point, I have access to the most exciting investments, and I constantly remind myself that alternative investment marketers are the best in the business, yet their return assumptions are rarely achievable over the long term. Steering clear of these opportunities is a great way to avoid big mistakes and stay on course. I don't invest in alternatives, so check for me as well. Four, a framework for giving tzedakah. Giving charity is not only important because it's a mitzvah, it also reminds us that all wealth ultimately comes from Hashem and that we are merely stewards of it. Being a steward means using money to lift up others who may be in less fortunate situation. You can't give to every worthy cause, so I urge clients to choose a few that matter most to them. Staying committed to giving away a portion of your cash flow each year to meaningful organizations is essential as investing and financial planning. I've been doing this, but most of my charitable dollars are given closer to year end around the holiday time. So I guess I'll give myself a half a check for that because it's not complete yet. Spending money to enjoy life. Hoarding money is the wrong approach. After paying your bills and saving for the future, it's important to use money to spark joy. I'm a saver by nature, so I often feel guilty when spending on discretionary items or experiences, but that guilt is misplaced. Money is meant to enhance your life and the lives of your family. In 2026, I have tried to spend on things that elevate my life and bring joy, whether it's in trips, seeing a show, buying new undershirts, and enjoying a geschmack piece of kukos. Bottom line, hopefully my financial framework is helpful to others, and as far as I'm concerned, I'm currently on track to stick with these goals that I outlined at the beginning of the year. And with that, it's a wrap for this week's show. Any comments or questions, feel free to reach out directly to me via email. I love hearing from my listeners. And finally, the secret to financial success is no secret at all. It's to spend less than you make, invest the difference prudently, and ignore all the noise. See you next time on Jonathan on Money.